Welcome. This is the Lifetime Cash Flow Through Real Estate Investing podcast. This is where you'll learn strategies to help you achieve lifetime financial freedom through real estate investment. Your host, Rod Khleif, has owned over 2,000 homes and apartments, and he brings experts in all aspects of real estate investment and management onto the show. Now, here's your host, Rod Khleif.
Hey, just a couple of quick things. You guys know I'm a huge proponent of mindset and the psychology of taking action, and how it's my belief 80% of your success in anything is your psychology and your mindset, and really 20% is the mechanical stuff, the real estate knowledge. You know, I even recently did a Facebook Live clip on creating vision boards and how do you use those to get your goals and things you want. Well, you guys aren't going to believe this. You're going to absolutely love who I've got coming on the show on September 25th. John Asseroff from The Secret. He's the guy that showed us his vision boards in the blockbuster movie, The Secret. In fact, he's the reason millions of people now have vision boards. John is that guy. So make sure you check out that episode on September 25th. It will be epic. And I've finally launched my course and coaching program. If you're interested in this business at all, I can humbly say it's the best multifamily course out there. And I personally coach you on how to crush it in this business and in your lives. So if you want to get more information on my course and coaching, text the word crush to 41411. And last, I've created an incredible Facebook group for you guys. If you're interested in multifamily investing at all, already over 800 people on it. I'm sure it'll be to 1,000 here shortly, and it's very active. And all you have to do is go to multifamilycommunity.com, and there's a direct link to the page. So go sign up and can peer mentor and learn from each other. It's just an incredible environment. All right, let's get to it. Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Rod Khleif, and I'm thrilled you're here. You guys are going to get a ton of value from the gentleman we're interviewing today. His name is Cody. And we're kind of taking a sidebar on multifamily investing to talk about something that's very, very important as it relates to being a real estate investor, and that's tax planning, because nobody does it. In fact, myself, I'm guilty of it as well. I'm typically working backwards to try to solve problems instead of being proactive. And so I thought it'd be really helpful to have Craig on the show. Craig's a certified tax coach. He's a CPA, been a CPA for 17 years. Actually, before that was a police officer in New York City for 17 years. And Craig has a CPA practice that focuses on tax planning, being proactive. Craig, welcome to the show, buddy.
Well, thank you very much for having me.
Absolutely. So you also co-authored a bestseller called Secrets of a Tax-Free Life. That's on Amazon. And I know you've got a gift for my listeners that we'll talk about here in a little bit. But I appreciate you being on the show. And I know that you've had a tremendous amount of training in tax strategy and being proactive. So I'd like to dig right in and get right into what my listeners need to know. And as you know, my listeners are aspiring and or even very successful multifamily real estate investors. So what is tax planning?
Tax planning is looking for ways to take advantage of the tax code for things that you're already doing and making those things deductible legally. So most CPAs and accountants, they don't do tax planning. They're typically recording history instead of making history. They're looking in a rearview mirror. So when you plan, you're looking for ways to help your clients keep more of what they make.
Right. Okay. And like in the case with my CPA, my own CPA, it's always the last minute. We're always going back and trying to fix anything that might have happened. And I'm guilty of it. And I know a lot of you guys that are listening are guilty of it as well, not being proactive and taking steps to maximize all the benefits that are available. And I will tell you, I did step out of that a little bit last year and did some things that we'll talk about here on the show that really helped me. But this is so important for those of you listening to be proactive, to get ahead of the curve, because there's so many deductions in the tax code that people don't take advantage of that are right there. And we're going to talk about those. So let me ask you this, Craig, would you say is the biggest mistake that you see, or some of the mistakes you see real estate investors making tax related?
Number one is they fail to plan.
Okay.
And that could be wrong entity choice. That could be holding, very often we see people holding all their real estate in their own name, or maybe inside of one entity. That entity may be an LLC or maybe a corporation or an S corporation. And that's typically not a good idea. But not taking the time to plan, not working with all your advisors. Let your attorney and your financial advisor and your CPA communicate. They should want to communicate. There's a lot of good reasons for them to communicate. Okay, that's in their best interest.
Absolutely. Now I want to go back to something you just said about entity choice. Now, what I tell my listeners, and I'd just like to get your opinion on this, what I tell my listeners is ideally you want your properties in property specific LLCs. Now the only difference to that is if it's just a duplex, you could put a handful of those in one, but if you're buying a larger property, at least let's say commercial property. Commercial would be 5 units or more. If it's 5 units or more, I'm going to tell you every single time, put it in its own specific LLC. And then you're going to have each one of these properties in a property specific LLC. And then my suggestion is you have a holding company LLC that owns the membership interests in the property specific LLCs. Is that a good strategy?
It's a good strategy. Having multiple in one entity, has its downfall.
Right.
We've actually had a client where they owned them personally, and they were $25,000 properties, and she was sued for mold-induced injury. And apparently, there's a cap on insurance for mold, which was only up to $25,000, and the jury award was $150,000. So as she sells each of the other properties, the checks go to the
Well, there you go, guys. Now, I will tell you, when I had 800 houses and multiple apartment buildings here in Florida, the apartment buildings were always in individuals, but I had sometimes as many as 20, 25 properties in an LLC. But that's a horror story that you just described, and that absolutely could have happened to me when I was like that. So if you want to be super careful, then put each one in its own LLC, because you're not going to be paying for multiple tax returns if they all feed into a holding company, correct?
Correct. If they're all single member LLCs and they're flowing into one holding company, then you have one tax return. So you need to keep books and records like everybody else, but there's no extra cost there. And depending on the state you're in, it depends on, in New York, it might cost you $1,500 for an LLC, but we have clients in Pennsylvania and it's about $150. And
here in Florida, it's very inexpensive. Yeah, I know New York's crazy. I think California is pretty expensive as well. But they also have these new LLCs where I think it's almost like you can have multiple LLCs inside of the same LLC. And I'm not too up to speed on those yet, but I've been hearing about those.
Yeah, and I don't think that's been tested in court yet either.
Okay.
They're called series LLCs.
Yeah, that's right. Series, yes.
Yeah. Mm-hmm. So, like I said, you have to kind of look at what's the cost. Is it worth it or it's not worth it?
Right.
And especially if you're doing planning, then, when you're doing that planning, just get that LLC formed and put it in and you're okay.
Right. And yeah, and you can most states you can just form them online. There are lots of companies that'll help you with this. You pay $100 plus the filing fees. Okay, so the wrong entities. What other mistakes do you see real estate investors making when they come across your desk?
Depreciation, cost segregation is a big one.
Cost segregation, yeah. Let's talk about cost segregation for a second. So describe that to my listeners, please.
So let's just say you bought a property and the building itself, the house, which a residential rental, was worth $100,000. Under standard depreciation, you're going to depreciate that over 27 and a half years, which works out to approximately $4,000 a year in depreciation expense. If you do a cost segregation study, they break that house into different pieces, such as equipment, maybe 7 or 10 or 15-year property.
Let me expand on what you just said so that everybody's clear. What they do, guys, is they basically take the different components in the building and they assign the useful life to each one of those components. So, from the doors to the windows to the electrical to the HVAC, even to the concrete outside. I mean, it's crazy what they break up on these things, but everyone has its own useful life. And correct me if I'm wrong, Craig, what it allows you to do is basically accelerate the depreciation. Correct?
So over the 27 years, you still have the same $100,000 worth of depreciation, but you may get 20% of that up over the first 5 years.
Right.
And the beauty of cost segregation is if you don't do your study until year 5, in year 5, you get to pick up all that missed depreciation that you would have had if you did a cost segregation study in year 1. And let's just say you sold another property that year. So now you're able to offset it.
Offset that income. Yeah.
It's a great planning tool.
Yeah, I did it myself last year. I literally saved $600,000 and I did cost segs on properties that I'd owned quite a while. So it was a huge deal for me. So I highly recommend that strategy for you guys. And definitely something you want to explore and understand so that you can utilize it. And I will say you typically have to bring in an engineer to do the analysis, and they'll prepare a report that goes to a CPA. Is that how
Right.
you see it done? Right. Okay.
Yes, on a bigger commercial, but we actually work with a company that you could have it done on a residential property for less than $1,000.
Wow, that's
So,
very reasonable.
yes.
That's very reasonable.
So
Okay, fantastic. So what other mistakes do you see?
audit paranoia,
Oh,
failing to do something because you're worried that the IRS is going to come after you. Now, if you do something, whatever you do, you should always document it. And if you get a letter from the IRS, you have the backup right there. It's not a big deal. So documentation is key. Everything we recommend to clients, we make sure typically they're working with us. We're making sure they're documenting it. So another thing is the wrong retirement plan. It doesn't typically come into place with.
I'm sorry.
Let
Let me just hammer one thing home because you didn't really hammer it home, guys. Good record keeping is critical. Okay, if you're going to do any of these advanced strategies, you have to have good records. So I just wanted to put an exclamation mark on that. Don't play around with the IRS if you don't have good records. But it's not that hard. Use your credit card to pay. You keep your receipts. You keep track of what you're doing. Anyway, I apologize. Please.
No,
continue.
that's fine. That's
okay.
Another one is missing family employment. Okay, hire your kids, make their high school tuition or their camp tuition deductible. So what you do is, the court says you could hire your children as young as 7. Okay, we typically like 11 or 12. All right, they come in. They do something, you pay them a reasonable wage, you make sure you document that. The money gets deposited just like everyone else's payroll into their bank account. The high school tuition comes out, they have them draft it right out of their bank account, or their hockey camp or whatever it is comes right out of their bank account. So now you've made that tax deductible. And if you're in a single member LLC, there are times when you don't even have to, if you do it right, you don't even have to pay FICA tax on that money.
Wow. So they're no longer slaves. Your children are no longer slaves, guys. You can actually hire them and have a tax benefit. Love it. All right. What else do you see?
Missing medical benefits. A medical expense reimbursement plan, which is a Section 105 plan, which allows you to, let's say, hire your spouse in your single member LLC. Her wage is the medical expense reimbursement plan. And that is basically you get to deduct your out-of-pocket medical expenses. So that could be braces. That could be eyeglasses. That could be special classes. Maybe one of your kids has ADD or something, and they say he needs to take Taekwondo, and the doctor gives him a prescription for that. It could be people a little bit older. We have a lot of clients where they're going for implants, dental implants, okay, which could be easy $25,000. So now you made what's basically a non-deductible expense, because on our tax returns, in order to deduct something on Schedule A for medical, it has to exceed 10% of your adjusted gross income. So if you're making 100, the first 10,000 in medical expenses is non-deductible. So this way you take the full benefit of everything. And,
wow. That's huge. That's huge, guys. And so basically they would do this inside of an LLC and create this Section 105 medical expense reimbursement plan, and then write off anything medically related, or even quasi medically related. And this is what it sounds like. But I mean, you don't play around with that. But if, like you said, if the doctor says do something, then you can deduct it.
Right, and it has to be a reasonable wage, and you just have to. It's just planning. You're just doing some planning.
Okay. All right. What else do you see?
Missing the home office. Okay. If you're doing work out of your home, do you have an area that you use exclusively for your business? And it should be about at least 12 hours a week that you're doing that. And I know I spend over 12 hours a week just answering emails from my home office.
Sure.
And then what that opens up is now all your travel between your home office and your real estate properties and so on is now all deductible.
Or your home office and your other office. I mean,
exactly.
In my case, I'm in my main office now, but I've absolutely got a home office, and I work there a lot, as I'm sure just about everybody listening does, if you've got email.
Yes, and then it also opens up the opportunity for a on-premise athletic facility for your employees, which means could be your home gym, it could be your pool, all right, which now that stuff all becomes deductible.
No kidding. Yeah, I did that myself. I converted a big area into an incredible exercise room, and I'm able to deduct it. And I just started that last year. I wasn't aware of this until last year myself. So guys, you definitely want to look into this and take advantage of it. Your pool, it's just extraordinary. And it's in the tax code. It's completely legitimate. You don't have to be afraid of it. You just have to document it. I think you have to do some measurements. You have to know the square footage of the house and the square footage of the facility, the home office, things of that nature. There's some hoops you have to jump through, but it's absolutely worth it.
Right. And when we do a plan with a client, we make sure that they have the code in the plan that says you're allowed to do this. So if you go back to your accountant and he says, no, you can't do that,
and
he doesn't know about it. You open it up, let's go to the code, and it says
it. Love it. Love it. How often do you think a real estate investor should communicate with their CPA, and why?
On a regular basis, and that might be monthly. We communicate with our clients who are business owners and real estate investors on typically a monthly basis, and that might be phone call. It could be just an email. It could be a WebEx, a Zoom, or something like that. And just so you know what's going on, because if you're discussing things, you're going to learn what they're doing. And business owners, real estate investors tend to have that little bit of ADD. They're always doing something. And if you know what they're doing, you can help them do it the right way.
Right. Okay. So I think we've covered a lot of the mistakes, and I know you're offering a book on the 10 most expensive tax mistakes that cost business owners thousands, and that applies to you guys that are in the real estate business are all business owners. So I know you've covered a lot of them. And again, I know you've got the book Secrets of a Tax-Free Life on Amazon, but we will have a link to the book on the show notes, guys, so that you can access the 10 most expensive tax mistakes. And what haven't we talked about? We've gone over a lot of stuff quickly.
One thing we didn't talk about, which we talked in our pre-chat, was captive insurance.
Oh, yeah. Now, captive insurance is something that if you're really high net worth, there's a couple of supplemental strategies that you could consider. One of them is have your own captive insurance company. And it's expensive to set up. You absolutely want to use groups that specialize in this stuff, but it can be very, very advantageous, correct?
Yes. And then another thing is for your real high net worth people is basically foreign retirement plans where the U.S. has a treaty with them. And there's ways to actually put your assets into these foreign retirement plans. And so the asset might be a piece of real estate in Florida. Okay. And it gets titled into this retirement plan. And then you go and sell it down the road, and it's in a retirement plan, so there's no tax on it.
Wow.
And then you buy another piece of property.
Interesting.
And then there's huge benefits when you go to pull the money out.
No kidding. Yeah, and I don't know anything about that. That's very, very cutting edge. I know that that's something I've never even heard of. So that's something I'm going to explore. Very interesting. Foreign retirement plans. Do you have any idea what countries they're with, or? Yeah,
the one that we've dealt with is it's Malta.
Malta. No kidding. Oh,
Malta.
Yeah, that's kind of a tax haven. Interesting. Very interesting.
But the key is there's a treaty with the U.S. that allows you to do it.
Right. No, I mean, it's all legal. This is not gray. There's no crossing the line. There's no even fudging the line. This is absolutely legitimate as long as you document and, you work with somebody that knows what they're doing. Well, Craig, I really appreciate your valuable time today, sir. You've added a ton of value in a very short amount of time. Where can they reach you, Craig?
They could reach me via email at craig@ccodycpa.com. Our website is www.craigcodyandcompany.com.
Fantastic.
And our office phone number is 516-869-4051.
Super. And all that'll be in the show notes, guys. Craig, thanks so much for being on the show today.
Thank you so much for having me.
Absolutely.
Appreciate it.
All right. Take care.
Thank you for listening to the Lifetime Cash Flow Through Real Estate Investing podcast. If you've enjoyed the show, please subscribe and then take a moment to visit iTunes and leave a 5-star rating and review. For more resources to connect with us further, please visit our website at lifetimecashflowpodcast.com. Tune in next week for our next show.